It's getting difficult to read the financial press and miss on this new trend. Blue Crest is on a hiring spree amid commodities boom. Crops trader in high demand at hedge funds looking to cash in on commodities. Millennium hires veteran metal traders for commodities expansion. So, what is going on? Why are multi-billion-dollar hedge funds looking to hire physical commodity traders? This is what we are going to speak about in this video. But first, a moment of silence for my fellow physical commodity traders that moved to a hedge fund. Their social life must be horrible. As a former commodity trader myself, when I used to go to fancy, exclusive downtown dinner party thrown by a posh wise friend, in that environment, when I said that I was a commodity trader and that I focused on Africa, I could see all those looks. You know, those looks that say, this is because of people like you, that people are starving. If you add that to the fact that now you are a hedge fund manager, so you are basically a thief, I could only imagine that in the eyes of some people, you are a demon. And in the eyes of others, like a 20-year-old finance student, you are close to a god. Anyway, that's it for the intro. Let's dive in. To start, let's see where we are coming from. Since the last commodity super cycle, 99% of the commodity-focused hedge fund just closed down. The lack of volatility or the lack of trends made them perform poorly and the investor just withdrew their money. All the big hedge funds backed by physical commodity firms closed one by one. We had Clive Capital backed by LDC, Black River backed by Cargill, Armagero also had a hedge fund. They all closed down. Even the star trader and star hedge fund manager Pierre Endurant suffered from money withdrawal after a couple of bad years, even though he had a staggering performance. Look at those performances. In 2013, he returned 25%. In 2014, he returned 38%. In 2016, he returned 22%. I mean, this is not that bad. So for 10 years, it was a cardinal sin to mention commodity to an asset manager. For them, it was a dead asset class, especially in comparison with tech stocks, VC funds that returns year after year double digits. But that was yesterday. Today, it has changed. The commodities are back and ready to get revenged. A lot of smart people think that we are entering into a new commodity cycle. The lack of investment in new production capacity is hitting hard all the commodities. There is probably a lot of good reason for this underinvestment that's been running for like more than 10 years. But I think that the biggest one is this ESG energy transition movement. Think about it. For instance, let's say that you want to open a new palladium mine. Palladium, if you don't know, is a precious metal. It's a rare and silvery white metals that belongs to the PGM group. Palladium is a key component in the manufacturing of catalytic converters for vehicles, which help to reduce harmful emissions from automobiles. 80% of the palladium production goes to catalytic converters. But if we are moving to electric vehicles futures, where is going to be the demand for palladium? Because an electric vehicle doesn't have catalytic converters. Are we going to be needed palladium anymore? I'm not sure. So put yourself into the shoes of this miner. Are you going to put hundreds of millions to develop a new palladium mine if you are not sure about the demand in 10, 15 years? But in the meantime, we still need palladium. And the same is for oil. Are we going to be needing more or less oil in the future? Also, if I'm a big oil producer, my shareholder base forces me to think about the post-oil world. So I have to invest in renewable. But my main job is still pumping oil. What should I do? And what about copper? We need copper if we want to electrify the world, because copper is what is in those electric lines. So we need copper to transport electricity from one point to another. But where are we going to find this copper? Are we going to go to DRC with all the problems that it involves? Or are we going to go to South America, where there's a lot of countries just ready to nationalize your mine? Come and make do 1-2 billion investment and then just say goodbye to it. Or should we do it in California? I think in California, in the US, they have copper. So do you think it's possible to have a mine in California now? And it takes 10 to 20 years to put to production a world-class copper mine. Again, we need copper in between. Where we are going to find it? What are we going to do? The last commodity supercycle was led by China opening up and gobbling all the commodities. It was a demand-led cycle, demand coming from China. But this time, this is a bit different. It's going to be a supply-led cycle. And on top of that, if we add in the mix the reshuffling of the world order coming from one single polar world dominated by the USA to a multipolar world, I bet we will have a lot of volatility and traders will make a lot of money if they are able to capture it. And I'm not the only one who is taking this bet. Savvy money managers sees it and they are allocating capital to commodity hedge fund to capture it. Commodities hedge funds back in vogue after years of outflows. Commodity trading hedge funds are having a strong year. Commodity hedge funds are finally backed and they are raking in cash. So now that hedge funds are flushed with cash to allocate to commodities, they need people to pilot their trading activities. And who is better equipped than physical commodity traders? No? This is why I think that there could be a bit of a mismatch, because a physical commodity traders that makes money in a big commodity firm is not that easy that is going also to make money in a hedge fund. Because in a big commodity firm, you have a very good understanding of the supply and the demand. You have people on the ground, people at origin, people at destination, that can tell you what they hear. Someone at destination would say, yes, clients, they are calling every day. They want more, they want more, they want quote, they want quote. I mean, the market is hot. Or on the other side, they could say like, no one is calling, I need to follow up with clients, the market is very quiet, I don't know what is happening this week, and so on. And those data, the data that you really feel with the real market, with the buyers and the sellers, you don't get that in a hedge fund. So if you are based on those information to make your trades, are you going to perform in a hedge fund? I mean, it's not that straightforward. But again, I'm not saying that you cannot be a great physical commodity traders and a great hedge fund managers. I mean, we have proof in the past that you can be both. I'm just saying that it's not that easy to make money without intel of what is going on the ground. And the trading style of a physical firm and a hedge fund is quite different. Props to all the traders that made the move and that are going to make, I guess, way more money now. We'll see what is going to happen. So that's it for me today. I hope that you liked the video and please leave a comment below. Do you think that I'm completely out of my mind, that it's extremely easy for physical commodity traders to move to a hedge fund position? Or do you agree with me? Just, yeah, please let me know in the comment below. Ciao.